best, actually, would be to try and sort of come inside the company. We've heard this morning from a lot of investors and asset managers. How within Bank of America do you think about ESG, and how do you drive ESG into the way that you run the organization?
Well, I think that how we see ESG today might have been different 10 years ago. By the way, I'm not sure we would have known the words ESG 10 years ago. But it has become part of the fabric of a company that is trying to help people with their financial lives. And the E, the S, and the G, while a continuum, are not the same thing. E is literally our environmental business. What business are we doing that would be environmental in nature? And we made a $125 billion commitment. We are about 4 years into it, and we're over 60 billion, so we will easily meet and exceed that. I'd be happy to, without going through, how a bill becomes a law, tell you what kind of business we're talking about. But it's largely energy efficiency, wind, solar, et cetera.
Okay. And this is lending? Or investing?
Lending, financing, investing.
Okay.
We've also developed a program called Catalytic Finance Initiative, where we and about 8 other financial institutions, not all banks, and not all in the U.S., so it's global in nature, have looked for, we seek to raise 10 billion, we're at 8 billion, and it is literally so that we can invest or finance initiatives that any one of us wouldn't be able to do alone, either because the risk was too high or the return was too low, but on a combined basis, we can get the kind of return and de-risk it so that it's attractive.
When you say that 10 years ago, ESG wouldn't have been something that anyone would have talked about, can you sort of identify a moment from the bank's
Well, just the
perspective?
words. I think that there's always been this sense of corporate social responsibility, but I do think in financial services, we had the opportunity post-2008 to take a pretty hard look at ourselves, along with everyone else taking a pretty hard look at the financial services industry. And what kind of company did we want to be going forward? And banks at their best are financial transportation systems to the world. How could we plan on today and the future, attract the best employees, keep them, keep our clients, and be a productive member of the community? So that's how we approached ESG. And it had to be on the fundamentals of business, not a bolt-on of, well, we'll do this for business and then we'll do something volunteer over here. So that's what I mean. So
could you give an example in the core business about how those sensibilities inform your decisions? So if you were moving into a new market, for example, would ESG inform your choice of location? Or maybe there's a better example.
So everything would inform it. When we put a headquarters in New York, we have the first platinum LEED skyscraper in the world at One Bryant Park. I don't know that we would have, actually we did that 10 years ago, but that was maybe the first move we made. We think about our employee practices, $15 minimum, maternity, paternity, making sure that LGBT community feels completely comfortable to be attractive as an employer, but also just on business, that what kind of business are we willing to do? It's part of the risk framework. What kind of business will we do and what kind of business won't we do?
Christy, can I come to you, because we were just chatting beforehand. You sort of said that the past 12 months you sense a shift in the way that people think about these issues. What do you think's driven that, and what's the evidence for that?
Well, I think given that Europe is far ahead of us here in terms of ESG integration and thinking about integrating ESG into corporate behavior, I think there's a lot that's happened in the last 12 months, and there have been some examples in the proxy voting world where investors have gone against management that they think really, in the cases of Exxon and Occidental, where they sent a strong message to management that they don't care. Now, of course, these are outliers that where the investor community has decided to single out certain companies that they think aren't acting responsibly and longer term. And this is, in my opinion, a real sea change. I think companies. There are great companies like Bank of America that have been integrating ESG into their framework, into their DNA, but there are other companies where I think investors have said, no more. It's not okay.
And the investor rationale for doing so, is that Is that they want to be good stewards? Is it financial returns? Is it time horizon? What drives that?
Well, I think that what's changed lately is that universal owners, and I would say pension plans all around the world, expect those who they hire to operate on their behalf, be it BlackRock or Vanguard or State Street as an index provider, and they expect them to stick up for important social and environmental principles. And when they see companies deviating from this, they will file shareholder proposals. So I think those institutions have been pushing the envelope on these issues for, I would say at least 15 years in the case of U.S. big public pension plans where I worked and oversaw our proxy voting. But what's changed is, the large asset managers underneath those institutions, not the public pension funds, but the Vanguards, the BlackRocks, and the State Streets index providers that obviously control a lot of the proxy voting, are willing to come forward and say and be stronger advocates on behalf of social stewardship and environmental stewardship, and they're not going to be silent anymore. I think they feel that, as in Larry Fink's letter of last month, that we have a higher duty of care in society and in civil society and communities.
Could I just add one thing, because it's just a practical issue? I'm part of a team that meets with our institutional investors throughout the year. Mm-hmm. 3 or 4 years ago, we talked about ESG, but it was sort of, I think that, it was considered part of the coffee break. We talked about it, but it wasn't fundamental. Today, they have people that are in the room. It is very much a part of the conversation. It's expected, and you're expected not only to be talking about it, but to demonstrate metrics in terms of your business, your practices, how you're doing with any one of these third-party evaluators, and how you see it helping the company in very fundamental, practical ways.
Okay, that's interesting. What's the hardest question they ask?
Hardest question they ask?
Yeah.
Returns on the kind of business we're doing, and how do we think about that?
Right.
I mean, when you're asking what's the hardest question in terms of when it comes down to it, can we demonstrate reasonable returns against the investments or the financing or the risk?
Right. Brace, can I bring you in here? So, from an Arabesque perspective, I think you agree that something very fundamental is going on. What do investors, whether individuals or institutions, what are they looking for to marry these financial and impact goals?
Right. So I think there's a fundamental change, and you go back to the first panel, and a lot of it was about vocabulary and do people care. I think the industry has confronted or approached this from a perspective of how do I develop a product, and I need to define this product to be able to sell it. And I think that has just fundamentally changed in the world. And starting with individuals, and we'll come back to institutions for a second, but I think individuals want to be heard, and they want to customize, they want to have a nuance around what the financial assets they hold and how do they represent their mission and their values or their view on impact and sustainability. I think this vocabulary has been a confusion, but it has been fundamentally driven by this product fixation of the industry we all live in. And so I do think that the industry is in the midst of having to address this kind of lifestyle view of finance. The industry is going to have to address that other consumable products are looked at in different ways. My kids are all in college, and they make choices that are very distinct about the clothes they wear, how it represents them. And I think finance has done a terrible job of doing this because it's very individualistic. Some of us may care more about environmental issues than social issues, or wherever it is in that spectrum. And we've been sort of preachy. We come out and we say this is right and this is wrong, this is appropriate, this is inappropriate. At the end of the day, I think the capital market, if you give everybody a choice, the capital market's a pretty good adjudicator of these things. If every person could invest along with the things they care about, at the end of the day, we'd probably be in a better place than some gigantic asset manager saying this is right and this is wrong. And that, I think, is where the industry needs to focus, because it's got to deliver the product that the consumer wants. And ultimately, institutions will want the same thing.
Just in terms of agency to choose what you want, Christy, from a pension fund perspective, there was a question earlier in the day about fiduciary duties and whether that constrained one's ability to go towards the impact end of the spectrum. Was that your experience? Is that a constraint?
Well, it is in the United States still today. Apologies to any lawyers in the room, but you know, there are. I don't think the legal community has moved to the point where non-financial matters fall under the umbrella of fiduciary duty. If you're in a pension plan and you think about doing something that doesn't maximize risk-adjusted return, the lawyers will pull you aside, we'll go into closed session, and they'll probably give you a talking to, you know, or if the decision gets made, it gets made behind closed doors. Nobody wants to be seen making decisions but of course they live in a bubble. You know, they live in a big fishbowl, and so everything is scrutinized by optics. But my observation is, although Europe and many other countries have moved towards a broader definition of fiduciary duty, the United States is not there solidly. There are signs that it could be inching over that way, but I don't see it in a broad way.
And if I could bring you in on both the institutional side of things, whether you see that as a constraint, but also the retail investor, who we've nodded to in prior conversations as being an incredibly interesting space over time. But the options for retail investors to put their money to work in this way, from a Bank of America perspective, is that blipping on your radar? What do you do already?
It is. Just one thing on what Christy said. I do think on fiduciary that what's going to change that is transparency. So I think where the lawyers might leave off and the rest of the world is going is transparency. Not that the lawyers don't want transparency. On the retail side. So yes, we see investors, particularly in wealth management, mass affluent, that they want something that they can be comfortable with. So what I mean by that is there's a lot of discussion earlier in the day, are you trading off a return for social impact? I think there are enough things now that people can invest in that are de-risked enough that if you're looking for on a full portfolio, obviously on a balanced portfolio, some of what you're going to do might give you the return of a muni. That might be the same thing you could do in social impact. So it may not be your growth fund, might be, but then you take higher risk, of course. And we do see that. So we see a growing population in our Merrill Lynch consumers, clients, that are asking for this. And really, you're really working in this space.
But I also think on the institutional side, that on retail and on the institutional side, there's real tail risk to companies behaving poorly. You know, we've seen, let's take Volkswagen, for example. One could argue, who knows, but 15 years ago, if Volkswagen said what they said today, would the stock have moved as much? I don't think so. I think the market, because information is available, I think our standards of operating have changed. And so I think the vocabulary was used earlier in one of the sessions. This license to operate a business now is becoming important. You know, companies have to operate in guardrails of acceptable behavior to the marketplace. And it will be adjudicated by the consumer or the regulator or both. And you saw it in Volkswagen, you've seen in other examples. And because information is now readily available and accelerating in its availability, if you're running money or you're running a company and you're not paying attention to how the marketplace is perceiving you, you're going to underperform, your cost of capital is going to be uncompetitive, and your stock is going to underperform. And I just think that is something that has to be priced in. And the availability of information is not decreasing. Obviously, it's increasing. And you can just look at the sexual harassment issue in the last 6 months. If you look at politicians and certain corporate executives at stocks, they've had a dramatic adjustment in price in a very short period of time. These topics are all going to become pertinent and will be adjudicated by the market.
Christy?
Yeah, I mean, we do live in a world of radical transparency, and so the reputation of companies and their brand is something that can be ruined in a moment after it's been built for decades. So no question about it. Companies need to start with acting responsibly internally and then be held accountable on the other end. And so I completely agree. So I'm not sure we need the lawyers to broaden the definition of fiduciary duty, as long as we have companies like Bank of America or others that can act responsibly and drive it into the DNA of the company, and all the way up and down, from the board all the way down.
Just to push back on this idea of radical transparency, how good are the metrics to prove that actually things are being run in a different way? So sitting outside the company, can I really tell that I know that you have a committee, but how do I really know that this is being taken seriously and is being driven through the decision making?
Well, I think you have to look at a lot of things. So our board is 30% women, 27% diverse. Our senior management team is 40% women. We have 43% of the population of our company is diverse. So already you have a discussion point that you might not have had otherwise, people with different views. We subscribe to all of the third-party evaluators, MSCI, GRI, CDP, Dow Jones Sustainability Index. That's a measure. The performance of your company, the transparency with which you speak, the programs, the returns that you're getting, how much you report on them with specificity, that matters. So it's not one of those things, it's all of those things. And the continual fishbowl that we're all in, so you have to expect that these questions are going to be asked constantly, and you have to be prepared for them. So I would just say it's all of those things, not one of those things.
Right.
Let me jump in now. So at Arabesque, we built a data aggregator that looks at now 7,000 companies. We look at 200 subcategories of ESG that we measure on a daily basis that is teased out of the market as those separate indicators are pertinent to total rate of return. So we've just signed today a joint venture with Accenture, where Accenture is going to embed that information in what they call their agility index in the evaluation of companies. So we'll give them on a daily basis a heat map of these 200 indicators that they can be able to help advise companies on how the market perceives them on these issues around environmental issues, on social issues, on governance issues, and other things that are pertinent to the price. And so I think that there is more and more data available that you can aggregate in a way that's beneficial, that can help inform these things. And that, I think for a company, it's very hard because they're very complex organizations, global in their nature, things are happening. And a lot of this information is hard to aggregate and to synthesize, and there are ways to do it.
We have 2 reports that we've put out, a third that's coming out from equity research. So it's done on behalf of all companies, and just to look at, does ESG matter? And they can absolutely describe and prove the value of ESG in terms of predicting bankruptcies, risk, and then certain industries where it really will make a difference. For instance, in real estate, to have built for energy efficiency is certainly going to be more valuable to both the investor and the marketplace on a go-forward basis.
So there are some things that people can ask of companies to figure out if they're at the highest level of maturity on these matters. So one of the things you can look for is a company that has a board level and also senior management, but also including external stakeholders, committee to address their sustainability impacts, not just the impacts, but the opportunities. The Business and Sustainable Commission in the UK just identified $12 trillion worth of opportunity between of impact in energy and infrastructure. So there's huge opportunities out there for companies, and I think asking companies how they're innovating to take advantage of the opportunities, but also how they're handling risk. One question I always love to ask companies is, okay, tell me about your sustainability officer. Where do they sit in the building? Who do they interface with? How often do they meet with the board? Is there a committee that runs vertically, right down the company, which includes the board and integrates sustainability through everything, including internal audit, including elements of innovation, including the people who are predicting return on invested capital on projects? So I think there are ways to identify leading edge companies that have figured it out. And then I would go back and say, and tell me the stakeholder groups that are included in that conversation. And you're going to need to see, civil society. You're going to need to see some academics. You're going to need to see people who really understand the impacts on the supply chain and maybe indigenous peoples in emerging markets. So I think that there are questions to ask to figure this out, and there are a few companies that are leading edge, who have one of these, stakeholder-based and also leadership committees to figure out their innovation and also the risks.
And I know you've grappled with reporting standards in your time, but so
Yes.
standardized ESG reporting disclosures, how good are they?
Well, I think it's unfortunate that we didn't start before 20 years ago. We have some voluntary frameworks. We have some KPIs. They're progressing. I obviously chaired the board of the GRI, full disclosure, and so I think there are challenges with the frameworks, but they're getting better. One of the things we need is, in my opinion, sort of more auditing and an assurance surrounding the truthfulness of these standards and these frameworks. The other thing I think we need is something like the IIRC, the International Integrated Reporting Council, integrate the non-financial with the financial and more holistically look at how these two are connected. So there are limitations. I think, before I leave, so one more point about my last remark, ask companies what they're doing about the SDGs and how they're going to report their contributions to the SDGs. This is a big deal, and I think if companies can't answer that rather quickly and efficiently, both on the risk and the opportunity side, I think that's concerning.
And can you guess my next question?
What are we doing?
What do you do on the SDGs?
Okay.
Well, we have a head of ESG who's essentially our sustainability officer, and he's right here, Andrew Plepler. We have a committee, an ESG committee, which is made up of the heads of the lines of business as well as the staff areas in the company. We do a report. We have formal quarterly meetings. We report out everything in the company. We make decisions with this committee, so it's everything from what we're doing with indigenous people and mountaintop shearing to whether we will or will not invest in a company that is sort of outside our risk parameters. Also, where do we need to invest more money? I will say, I think actually we're doing it without a whole lot of bureaucracy, because I fear that what some people in the room are thinking is this just sounds like a big bureaucratic morass, and it isn't. So we have been able to do it, make more money. Our stock price, our performance as a company, from reputation through true performance, has all improved with this. So it has not been an impediment. I think it has been a force to move us forward.
Are you implying that you've been able to disaggregate the effect of your ESG activities on the stock price?
I think that it has had a positive effect. Because I think that ESG is just a continuum of what kind of company we run. It isn't a bolt-on. It is part of the DNA of how we run a company, and we saw opportunities. So yes, if we're the leading underwriter of green bonds globally for the last 3 or 4 years, that's good. I mean, that's business.
On SDGs.
Yeah, coming back to the SDGs, what we're working on, and I think this comes back to the preference question again, we envision an opportunity where you can go to an institution or an individual and ask them to frame their profile of interests around the SDGs.
Right.
So imagine that you give somebody 100 points to allocate against the SDGs. You decide what your profile is, because I think most people wind up having a pretty consistent set of mission and values. You can then decide what and this could be across securities, we're mostly focused on public equities, but you could decide what securities would meet that mesh of standards that will be acceptable to you individually or institutionally, that meet the goals of the SDGs. The SDGs are
or what your company does.
Or what your company does, whatever your preference is at the end of the day. And then there's plenty of good tools to pick the best securities out of that relative to the risk and the return profile that you want. And I heard earlier this conversation about is it higher or lower returns. At the end of the day, those can be adjusted. I mean, we've got the tools to understand how to manage risk and what return is associated with the risk that comes with that. Some of it is just what's available in the market. But if you can frame what it is that's acceptable to you and then pick the things that meet those other expectations, that seems like a perfectly rational thing. And we should get away from this view of you're beating an index. We made those up. You know, we all decided that there was a market cap index that was better than
I want to
somebody
tell
else's.
my clients that.
Well,
They're all made up.
But the industry made it up to measure who got paid the most and who raises the most money. And so I think as the industry gets changed, you know, you can have different standards to judge who's winning and losing.
So I have to chime in here a little bit about the SG contributions because GRI, along with the UN Global Compact, in the last 18 months has developed a tool on 169 targets, over 17 goals, and how companies, and it enables companies to report on their contributions to the SDGs. And I think this is, you know, and how to be transparent, but also how to prioritize their contributions.
It's also practical.
Yeah.
I mean, it's a tangible.
Yeah. And so there are tools out there for companies to fully disclose. And in fact, I think in June or July they're coming out with it, a better interface, on how to explain how companies can better disclose their contributions.
Let's throw it open to the room. Raise your hand if you have a question, or you can use the app. Thank you very much. That's the legacy generation.
What?
Thank you. I appreciate the recognition, I guess. There's someone sitting at the table with me here. I'm going to have to ask her to do a documentary for me. So, as I was listening in the earlier part of the discussion, you were talking about the various metrics, the indexes. There was the agility index that was mentioned. I'm curious if we're seeing any impact on short-term versus long-term perspectives by the performance of companies. You know, it's a pretty common theme in the media that, companies are all short-term, focused on next quarter's earnings and so forth. Are you seeing anything there that, is kind of driving it one way or the other, or is it sort of indifferent?
I have an opinion.
Go ahead. No, go ahead.
Christy, you go first.
Well, I have to explain I'm a capital markets person. I used to sit on a derivatives exchange, and I'm going to say no. I don't see anything changing, and the reason I don't is that there is a proliferation of short-term strategies that provide liquidity for order flow and price determination in the marketplace, and I don't think they're going away. And this is. I have a very philosophical view towards this, although I'd like to think of myself as a sustainability person and led the GRI for years. I'm also a realist on capital markets, and financial innovation is indigenous to our culture. We saw the good and the bad of that in the last 10 years, but there's no way, in my opinion, that we're going to shut down let's say, trading schemes that provide liquidity and obviously are providing alpha to some party, or they wouldn't be funded. And so, do I think that means that there isn't a big piece of the world that is going to long-term strategies? Yes, there are, but I don't think the short-termism and the volatility that it creates, which we've witnessed in the last 2 weeks, is going to go away.
The only thing I'd say is I do see companies asking the questions. They are reflecting on the available information. Their first reaction is to object because they believe that you don't understand what they're doing. But then they look into it. They're cognizant that the impact on their capital costs will be influenced if they're on the wrong side of these guardrails of conduct. And so I think more and more of them acknowledge that they need to understand those issues and start addressing them. The reason Accenture is doing this is because they're being asked by their clients to give them advice how to deal with these risks. So, are we in the ninth inning of this? No. Are we in the first inning? Probably. But I think the genie's out of the bottle, and the capital markets will provide this discipline over time.
So one other thing I would add here is that increasingly companies are refusing to give quarterly estimates on earnings because we have a huge analyst community who can figure those out, who can model earnings to the decimal place of who knows. And so I think that getting away from that should help. I sit on the board of a company that doesn't forecast quarterly earnings, and we've done just fine. So I think boards and CEOs being willing to, direct people's views to the long term, as opposed to what's going to happen next quarter, is a useful trend, and I hope it continues.
I would give just a practical answer. So I think that we're always going to be evaluated by quarterly earnings and performance on the one hand. On the other hand, companies make choices. So companies could make choices relative to COP21 and the commitments made during the Obama administration toward the environment that were, from a government perspective, reversed under the Trump administration. And we had to make a choice. Do we stay the course? Because these are big, long, audacious commitments we're making, in our case, $125 billion, or do we abandon that? So we stayed with it because we actually think the business is there, it's the right thing to do, and we're trying to operate a company that will go into the next century, let alone operate for the next quarter.
Can I just ask how the rise of passive feeds into this? It can cut in a couple of ways. I mean, it sort of leads to greater long-termism, but potentially reduces the ability of investors to enforce their preferences if they can't buy or sell with the same agency. So how do you think about the rise of passive in this context?
I will tell you then, I'll use it again more practically. When you meet with pension funds, they actually are forcing, I think, companies in their meeting. First of all, they want meetings with companies. They're passive investors, so they're long-term. They're there in the long term, but they will vote with their feet, and they let you know that if you are not performing sort of as a citizen of the world on a go-forward basis, not in some nebulous, I don't know what that means way, but rather, what are you doing in terms of? And you spoke earlier, Christy, about what Europe is doing. I think Europe's put ESG mandates in place. I think some Americans have actually performed on them.
Yes.
So,
yeah. Well, the global companies have to, because if you're doing business in the EU, you have to follow the European directive.
Yeah, but I mean, I think we're performing on them as opposed to making ascribing or hoping for 30% board women that we do it.
Yeah, I see your.
We have some questions coming in from the app, so I'm going to just parcel these out. So one is whether ESG expectations and third-party evaluations are somehow an obstacle to companies going public. So it sort of reinforces this private-public gap in terms of compliance. I might throw that to Christy. And then the extent to which ESG ratings depend upon self-reporting. We sort of talked a little bit about independent verification, but Anne, if I can come to you on that, how that works. And then social media impacting ESG and company behavior. We've kind of touched on that already. That's the radical transparency point. So let's just go with those. So Christy first.
So I'm going to say no. There is a view that, there's so many burdens on public companies that they just want to stay private because then they don't have to deal with us meaning the investment community. And I actually think the smartest private investors are doing ESG integration and looking at their companies more responsibly than ever. So that's my answer to that question. I don't think it's an obstacle. I think companies end up going public because of value, because of value generation and value creation. And if a VC firm thinks they're going to make a lot of money bringing a company public, I don't think any third-party evaluation of ESG is going to have them say, well, maybe not. We'll just keep it there. I don't see that as an obstacle. No.
And on the verification point, can we trust the auditors?
Well, I think you can trust the fact that there is more than a half dozen third parties that are evaluating companies. And if all of them, so we report to them, and they are not in cahoots with each other. So if MSCI, GRI, CDP, Dow Jones, And now we've got SASB and the task force that Mark Carney and Mike Bloomberg are initiating. If all of those, if you're reporting to all of them, and we are, and many other companies are, and they all can give you a rating that indicates your company is performing well, I'd say it's valid. I'd also say that it's cumbersome, and that at some point I hope that we will have a more streamlined way of doing it. I think that probably speaks more to, do people call things that are ESG, do they draw a circle around something and say, well, that's ESG? And I think that's a fair question, but they forget that on the E, business, there is real business there. So we see real business opportunity that we wouldn't have seen years ago on wind, solar, and particularly on energy efficiency and battery generation, just technologies that weren't there.
I think there is some question, though, about the consistency of the data and the rankings. MIT just did a study of all of the data providers in the space, and the correlation between them was only 0.2. So, I think the consistency across the board is a question, so that the industry is evolving.
So I think it's evolving such that more and more companies are getting their ESG reporting audited and assured by legitimate third parties.
Right.
And I think just as the evolution of financial reporting went through a period over history to require assurance and to ensure its integrity, I think you're going to see that in non-financial reporting.
Hi, Diana Glassman. So I have a question about how you value ESG. Because on the one hand, if you use a net present value discount rate approach, the terminal value accounts for the majority of value across companies, across industries. Yet, and a lot of times the stock price can't explain a lot of movement. So there's all kinds of intangibles. There's all kinds of large impacts on the value of the company. And the question is, how can we do more work to understand value, financial value in general? And is there some sort of an inconsistency? It just seems inconsistent to me that this is such a large source of value, and yet it can't be considered in short-term value if it's so big.
Okay, thank you. So how to value this and Christy?
So I think it's very difficult. It's a huge challenge for the impact investing community, for the asset class, I'll call it an asset class, and for the category, is that how do you value the social impact of ESG or the impact in your field? I mean, you're the innovators, and so there must be a reason why you've all gone down this path. And I don't know that we can ever quantify the full benefits of ESG integration or reporting. I think, and having gone to business school and having been schooled in dividend discount models, I see the challenge, and I don't have the answer. I think we just have to keep pushing for it. And all the impact investing companies that I know that are doing great things, they're still, kind of still looked at like VC firms, and people want to know what their IRR was. And in the IRR, there's never a data point for the impact. So I think ESG is the same way. I think it's very difficult to figure out what the value of that is, except to the extent that, for example, the $12 trillion that I mentioned in infrastructure and all the jobs that would be created, by innovation and opportunity, you can quantify that. I mean, that's something that you can discount back to present value. But otherwise, I think it's tough.